Good morning. My name is Jordan Small. I'm an associate here at Madden Hauser, and we are going to talk today about compliance under the Corporate Transparency Act. We're here because, this is a new law that not a lot of companies, not a lot of tax professionals, and frankly, not a lot of attorneys are prepared for. So we're here to help you understand the act, how it affects you and your clients, and how you can facilitate compliance under the act. So what are we going to talk about today? We're going to talk about first the who has to report under the act to FinCEN, which is the Financial Crimes Enforcement Network, which is an arm of the Department of Treasury aimed at combating money laundering. We're going to talk about what information you have to report. We're going to talk about how to do an analysis under these reporting obligations and how to figure out what to do if you are a required reporter. And we're going to talk about things that both attorneys and accountants should be doing to help prepare their clients for compliance under the CTA. So first, why does this act exist? It is a component of the Anti-Money Laundering Act that was passed in 2020, and that's really the basis of it. It is aimed to combat money laundering. It's aimed to combat shell companies and opaque ownership structures. So since 2020, they've been preparing for the implementation of this act, and it will take effect on January 1st, 2024. That is a date that's going to come up very frequently throughout this presentation, and it provides a good guidepost for the before and after the act and how that affects some of the analysis under the act. So first, we have to talk about who's required to report. What are the types of entities that are going to be required to come into compliance with this and to make the disclosures that the act requires? So an entity that's required to report under the act is called a reporting company. One of the key things that you want to see in order to determine whether you're a reporting company is whether that entity has been created by filing a document with the Secretary of State or a similar office under a state or tribal jurisdiction or a foreign jurisdiction. Basically, that state level reporting or state level creation is going to be a big guidepost for you to decide whether that entity is a reporting company. Generally, this won't apply to family trusts because they're not created through this method. And it also won't apply to general or co-partnerships, which are filed at the county level, along with sole proprietorships. So again, if the entity is not a reporting company, it's not going to be subject to the requirements under the CTA and will not have to make those disclosures. So along with the requirements for being a reporting company, the CTA outlines 23 different types of reporting companies. 23 different types of exemptions to reporting. We're not going to cover all of those today, but there is a through line to all those exemptions, and that through line is these are entities that exist in already regulated areas. Think of publicly traded companies that report to the SEC, banks, credit unions, securities brokers, and other types of entities that exist in areas that are already subject to reporting obligations and regulations. We're going to cover three of the most common exemptions. FinCEN itself and a lot of the scholarship around the act has said that these three exemptions are going to be the ones that most exempt entities fall under. And those are the large operating company exemption, the inactive entity exemption, and the tax exempt entity exemption. So first, let's talk about the large operating company exemption. As to the exemptions, this is going to be the one that is the most straightforward. Note that in a large operating company, in order to be exempt, has to meet all three of these conditions. It has to employ more than 20 full-time employees in the U.S. It has to have an operating presence at a physical office in the U.S. And it has to have filed a federal income tax return in the U.S. in the previous year, demonstrating more than $5 million in gross receipts or sales. So again, this is an and a larger operating company looking to meet this exemption will have to meet all three of these characteristics. Second, then this one is in comparison a little more opaque. This is an inactive entity exemption. And again, this is and an inactive entity will have to meet all of these characteristics. So inactive entities are in existence before January 1st, 2020. And that date is used because the act was passed in 2020. It is not engaged in active business, owned by a foreign person, has not experienced changes in ownership, and has not sent or received funds greater than $1,000, and also does not hold any type of assets, whether in the US or abroad. So when we're looking at this exemption, one thing that we've been telling clients, and one thing that we've been sort of internally discussing, is whether if a client has an entity that almost meets this exception, but is not being used actively, there may be worth having a discussion with that client about whether dissolving that entity before January 1st, 2024 is advisable, in order to sort of not have to meet these Corporate Transparency Act reporting regulations if this entity is already inactive, but not inactive under the Act's definition. So the last exemption that we're going to cover is the tax-exempt entity exemption. And so this is the one exemption that I think I am less qualified to talk about than everyone attending this presentation. So I'm not going to cover it in deep detail. But things to know is that entities organized under Section 501C, whether they are tax exempt or if they've lost their tax exempt status in the last 180 days, those are not going to be reporting companies under the Act, and they're not going to have to report. Also, political organizations under Section 527 and trusts under Section 4947A. If you have any specific questions about that, feel free to follow up with me. But those are just the basic tax-exempt entities. So we've talked about who has to report. Let's talk a little bit about when you are a non-exempt reporting company, what type of information do you have to report? So what you have to report is called beneficial ownership information. And I'll take a second here to do a quick aside. Beneficial ownership information is going to be sort of a misnomer here. The word ownership especially, because as we'll learn a little bit later, being a beneficial owner can be derived not only from ownership, but it can be also derived from control of the entity. So just to flag that as we move forward, beneficial owner and beneficial ownership is a more expansive definition than it presents on its face. So unless an exemption applies, the CTA makes you report entity information, beneficial ownership information, and again, regardless of ownership interest for those in control. And if the entity is formed on or after January 1st, 2024, information about who was involved in the formation of the company, and that's called company applicant information. We're not going to cover that as in depth today, but just know that there are things that will have to be reported for people who direct or actually make the filings for these new companies created after January 1st, 2024. So what's included in BOY? For each beneficial owner, you'll have to report the full legal name, date of birth, a current residential address, a number from a passport or other government issued ID, and the image itself of that government issued document. One thing to mention here, and this is sort of something that's going to come up throughout this presentation, is that because this is a new law that is not in effect yet, FinCEN itself has not identified the method by which this information is going to be submitted. There's no example submission form. We don't know whether it's going to be an online form to fill out, whether it's going to be a online form that has a Dropbox where you upload a package of documents. We don't know that yet. And we might not know it until January 1st, 2024. So I'm going to use this as a little opportunity to plug our website. We have a whole header on our website with Corporate Transparency Act information. It's being updated almost weekly with new blogs and new information as that information comes out. So as we know more, we'll continue to keep updated on that. and those will be blasted out via LinkedIn, Facebook as well. So keep an eye on our website and on our blog, just to keep yourself abreast of how this is changing. So here are the key reporting deadlines for this information. For existing reporting companies, and those are going to be companies that have been formed or before January 1st, 2024, you will have 1 year after the effective date, so until January 1st, 2025, to make your initial beneficial ownership report. For new reporting companies, as it stands now, any company formed or registered on or after January 1st, 2024 is going to have 30 days after the date of formation, which is going to be its filing with that Secretary of State or other organization to make its initial report. One thing I want to flag here is that FinCEN has proposed a new rule that would change this deadline for new reporting companies from 30 days to 90 days. That rule, the comment period has expired on that, and FinCEN is weighing the comments and whether to implement that rule to make it a little bit easier on reporting companies to ramp up and take the time to figure out their beneficial owners and to make that report. There's nothing that we have come across that would indicate that this wouldn't be implemented. But again, check the website, look at our social media. We will be updating you as this changes. And then lastly, reporting companies are going to have to update with changes in beneficial ownership within 30 days after the changes occur. And so those changes are going to be, the removal of a beneficial owner, the adding of an additional beneficial owner, that could come from the sale of the company. It could come from the death of a beneficial owner. So those are the types of things to look out for. And then that short 30-day deadline is something that you want to keep in your mind as well. So we know who has to report. We know what information we have to report. But the next thing to do is to figure out, all right, who are these people within these organizations, right? And this is where accountants are going to have a very unique position as people who are aware of the ownership, control, revenue, and other organizational information that's maintained by these entities. So they're going to have a key role in assisting entities with determining beneficial ownership. And to do this, I think it's important for accounting firms to keep developing a process for asking and soliciting their clients with the right information to help them gather that information about who owns and controls their companies and is thus subject to the reporting requirements under the Act. So these are the key definitions that are going to guide us through this analysis. As we mentioned earlier, a beneficial owner is an individual who directly or indirectly either owns or controls at least 25% of the ownership interest in the company, or regardless of ownership, exercises substantial control over the reporting company. And there are definitions that build on these definitions, and we'll cover them in the next slide. But keep in your mind both ownership and control. Again, a beneficial ownership can be arrived either through control, ownership, or both. And there must be at least one beneficial owner for every organization, but there is no maximum to the number of beneficial owners that has to be reported. So, identifying beneficial owners. First, you want to identify those who control the business on a day-to-day basis. Who has the power to act on behalf of the business? Who has the power to make those top-level decisions? Then identify who has the ownership interests, and calculating the total ownership interests, who holds 25% ownership interest in the entity. And again, the ownership interest should be the more straightforward of these analyses. Where it becomes a little more difficult and where a little more analysis is going to need to be done is at that substantial control portion. And so here are the definitions of substantial control and ownership interest. Ownership interest, pretty straightforward. It's not just equity though. So there are a lot of ways to meet ownership interest, and you should look within that definition to see if some of the more indirect ownership interests are met. Substantial control is where there's a little more analysis, right? It can be met by the individual being a senior officer. It can be met by if the individual has authority to appoint or remove certain officers or directors. It can be met if they're an important decision maker, What does that mean? It can be met if they have any other form of substantial control. So there are all these catch-alls, and it's going to be a very individual by individual, entity by entity analysis in deciding whether that person is going to have to make a report as a beneficial owner. So along with exemptions to reporting companies, there are exceptions to whether someone who would otherwise be a beneficial owner has to make a report. And 1, 2, 4, and 5 here are pretty straightforward. It's whether the individual is a minor child, whether they're acting on behalf of an actual beneficial owner as a nominee, intermediary, or custodian, whether their only interest in the reporting company is derived through inheritance, or whether they are a creditor of the reporting company. Number 3 here is where there's going to be a little more nuance to whether this person is exempt. And that involves whether they're subject to the will of the control in the employer and whether they're able to be discharged, whether their substantial control only derives from the nature of their employment. And C here is they cannot be a senior officer of the reporting company. And then in the act, the term senior officer lists a bunch of positions, including president, CFO, COO, general counsel, any other officer. So it gives it a more expansive definition, but those are the ones that it lists. And again, this is going to be an individual by individual analysis, especially if someone holds something that is not necessarily one of these enumerated titles, but close to it. So now that we know about the act, what can we do to talk to our clients to help them prepare for compliance? First, you can become familiar and stay up to date with the CTA, which you're doing right now. And I congratulate you for doing that on a Saturday when there's such a big football game later. Second, you can make your clients aware of the CTA, whether that's through a mass communication, whether that's through one-on-one conversations when you're already talking with a client. They might not be aware. And so talking to them about the aspects of their organization and whether they need to make a filing is important. You can advise them on the key deadlines. You can know and advise your clients on the penalties for noncompliance. And that is a $500 potentially a day fine for what the FinCEN deems as a continuing violation, up to a maximum of $10,000, and criminal penalties of up to 2 years of imprisonment. So this is serious. I'm going to talk a little bit about later about what we don't know, and what we don't know is a lot of the enforcement of this, but there are serious penalties by the letter of the act. So moving on, accountants might actually be required to file these reports on behalf of clients. They might have to actually go on and become familiar with the FinCEN website and how to make these filings. And then lastly, accountants might have to be responsible for the client's continued compliance, which is going to be monitoring the organizational structure and making sure that if there are changes to that organization, accountants are prepared to help their clients report. Here's what we're doing. We're doing a lot of the same things with actually making the filings, informing our clients of reporting deadlines, helping them determine who is a beneficial owner. But we're also doing a couple more things that have to do with corporate structures and corporate documents, which includes preparing corporate resolutions. We're preparing and amending governance documents like articles of organization, shareholders agreements, and appointing a CTA compliance officer, which includes indemnification provisions if someone fails to provide that compliance officer with beneficial ownership information. And we're also considering how this act plays into, acquisitions, sales of businesses, mergers of businesses, and whether these parties to those sales need to make representations about CTA compliance or designate CTA compliance within those agreements. So how can we help you? Basically, any question you have about the CTA, we're more than happy to dig into and answer. This is a very voluminous law with a lot of regulations and a lot of scholarship coming from the Department of Treasury about the law. So we're ready to assist you in any way possible in making those determinations, analyzing the law, analyzing your client's ownership structures, and then we're continually monitoring this for change. Plug the blog again. stay updated. But we encourage you to reach out to us with questions and to monitor our blog for updates to that information. So one quick note here, you might have noticed when we went through exempt reporting companies, one of the exempt reporting companies is a public accounting firm registered under Section 102 of the Sarbanes-Oxley Act. You may have more knowledge about that than me, but basically it is a accounting firm with the ability to audit public companies under that act. So if that doesn't match the definition of your firm might have to make an act or a filing under the CTA and report beneficial ownership. And we're more than happy to help with that as well. So as I've gone on and said this, again, I've mentioned many times, this is a new act. So there are a lot of things we don't know. And some of those things is, as we discussed, we don't know what a filing form looks like. We don't know what enforcement looks like. We've attended a lot of presentations, both by the FinCEN itself and by other organizations that say that enforcement initially of this is not going to come as strong as it can under the letter of the law. Obviously, we don't want to operate under that assumption. We want to operate that under the assumption that compliance is encouraged and corporations should do everything they should, and other entities should do everything they should to comply. We don't know whether there's going to be a safe harbor if a corporation or entity makes a mistake. We don't know if there's what they should do if they can't find that BOI information. We don't know if an incomplete report is going to be better than no report, or what is going to be preferred by FinCEN under the law. The last thing, and this has been the topic of a lot of scholarship, is we don't know if this is really going to happen. However, we're pretty sure it is. There is nothing that be indicated that this is not going to go into effect over the next couple months. There have been pressure from small business organizations. There's been pressure from legislatures, and everything that we have seen has shown that they're going to keep chugging ahead, and this is going to go into effect, whether certain business communities like it or not. So we're here to help you prepare for that implementation. We're here to help you and your clients comply. But this is going to happen most likely, and we're happy to help. So thank you for coming. I appreciate everyone showing up, and feel free to reach out with any questions, and I'll answer a couple of those questions later